Hello, everyone. This is Catherine McGreen and George Walper from the Spectrum Group. Thank you for joining us for our webcast today. We will be reviewing our monthly index numbers as well as talking a little bit about some research that we just completed regarding advisor relationships. I will turn it over to George Walper, our president, to talk a little bit about the findings from this month's Spectrum Investor Confidence Index.
Thank you, Catherine. For those of you that joined us last month, we were commenting about the index and wealthy investors' feelings and attitudes, which were quite interesting. And we said, let's see what the next month brings. And here we are at the next month, which we're now finding some very interesting trends. Traditionally, historically, back to 2004, the Millionaire Confidence Index, which are those folks worth $1 million or more, and the Affluent Investor Index, which is 500,000 or more, they tend to move pretty similarly. They move in parallel. On occasion, the gap gets pretty narrow, and we have that case here where the gap got significantly more narrow this month. But we have millionaires who all of a sudden are feeling nervous about things, their outlook and their confidence dropped, and yet we have non-millionaires, or the overall affluent market, 500,000, is a little bit more optimistic. And so that becomes kind of a scenario where we need to dive in a little bit more and sort of look at what's happening, why that is, and why all of a sudden are millionaires a little bit more worried than they've been in the last 4 or 5 months. You can see for the past year, and I said historically even in the bottom, but the gap between millionaires at the top and the affluent at the bottom tends to move in the same type of trend line, the same slope. You start looking at August, September, October, the previous 3 months, you see that. Last month, interestingly enough, the affluent dropped pretty significantly, much more than the millionaire. And here you have this month where now affluent went up a little bit, 1 point, but compared to millionaires, which is dropping at the same slope 2 months in a row, is kind of interesting relative to where we're going in the future and why are millionaires nervous about things like the pending tax law, etc. Their outlook, which has been pretty positive, trending upward throughout the year, generally speaking, dropped a little bit this month. It's still the third highest throughout the year. But again, is this a prediction of worrying about where the market is, worrying about, well, maybe the tax impact is not going to be so positive for these wealthy investors as perhaps they thought 60 days ago when it was simply a talk. A lot of red arrows here. As I look at our index, I'm never a fan of red arrows. But you can see the various components of the overall outlook. Components are generally down. Their household income they're concerned about. Their outlook for the economy is down. Compared to a year ago, it's pretty significantly down. And yet what's interesting is, compared to a year ago, it's up. But compared to a month ago, it's significantly down. And again, compared household assets, and at the same time, they're viewing that where they work or the company they own, that those are trending upward. So you're starting to get some cross signals about how people are thinking, what they're worrying about. The political environment continues to be the story that's most affecting their economic outlook. The political environment right now, throughout this year, as you know, are two big topics at a minimum. One is the health Affordable Care Act issue that did not get resolved and seems to be floundering out there in the background. And now the tax increase or tax decrease, or depending on who you are, maybe no tax change. You can see it's over here on the right, is now resonating up at 42%. Those are all very much linked together. International problems, we continue to be fascinated that Korea and the issues going on in Korea are not resonating as a significant international problem for these wealthy investors. Now, this was done right before this most recent launch, but even every other missile launch throughout the last year has not had these kind of has not raised the issues, and so that will be one that we'll have to see as it plays out. Here it is broken out by comparing affluent to millionaires, and you can see taxes are a little bit more of a concern for millionaires in terms of just that story about tax. How are they going to invest? Again, kind of interesting that even with those types of outlooks and concerns, you can see that equities are similar to where they were last month, so people are not really necessarily in a significant way pulling out of the market. Yes, they're a little lower. Same thing with fixed income investments. Real estate, kind of interesting, raised its head a little bit, and that perhaps people were saying with interest rates going up and maybe the market being at an all-time high, and real estate might be the time to think about income-producing real estate. It's an area for wealthy investors, has always been popular. It's been down the last year or two, but it might be starting to say, let's take a look at that. So with this, I'm going to switch it over to Kathy to talk about our most recent research about advisor relationships.
Thanks, George. Every year we do significant research with individuals regarding their relationship with their advisor. We generally tend to do it this time of the year, and we're just coming up with our results from the most recent study. As you can see, we really focus on how are people using their advisors and what is it that their advisors can be doing better. As you look at each of the different wealth segments that we generally talk about, the mass affluent, who are households with $100,000 to $1 million of net worth, millionaires, who are those with $1 to $5 million of net worth, and the ultra high net worth, who are households with more than $5 million of net worth, you can see that as wealth increases, so does the likelihood that one will use a financial advisor. We also ask the individuals whether they feel they are knowledgeable about financial products and investments. And as you can see, most investors feel somewhat confident about how much they know about investments, whether that's true or not, or whether they really have that expertise is questionable in some cases, but that's the feeling that they have regarding how much they know about investments. So as you can see on the right-hand side, the ultra-high net worth are the most likely to believe that they have the greatest financial knowledge. And this may be true, and consequently those who are in the mass affluent are the least likely to believe that they have the most, are very knowledgeable about financial products and services. What type of financial advisor or what type of an advisor do these different investors use? You can see full service brokers remain the most common kind of top advisor used. However, I would argue that these numbers are slightly lower than they have been in the past. Accountants are important advisors for a lot of these individuals, and that doesn't mean that they're investing their money necessarily, but it does mean that they're relying upon them for some information and some advice regarding about how they should invest. Independent financial planners, you can see, are really important for all three different segments, and they continue to grow in importance. For those who do not use an advisor, for the 20% of the ultra high net worth, etc., that aren't using a financial advisor, why do we not have a financial advisor? We ask that question. The most common answer for a lot of individuals is that they don't believe a financial advisor would be looking out for their best interests. But you can see that those cocky or confident ultra high net worth individuals are more likely to say that they can do a better job of investing than a professional. Of course, it could be that in a lot of cases some of these investors may be in the financial services industry, so therefore they may feel that they have some knowledge. But those are the two primary reasons. I cannot afford an advisor is a large reason for those who are in the mass affluent market who really don't feel confident that they have enough money to go to an advisor. Overall satisfaction by wealth with their advisor, we'd like to compare this to right before the recession in 2008, because that's when we generally found that the highest levels of satisfaction were with financial advisors. So you can see slowly we're returning to pre-recession levels with the confidence factors in the different wealth segments, and in fact the ultra high net worth have finally reached the same level of satisfaction that they had prior to the recession in 2008. One of the biggest ways to determine whether or not an individual really is satisfied with their advisor is to ask them whether they've actually referred their advisor. As you can see, as wealth levels increase, so does the likelihood that one has referred their advisor to a friend or family member. And then we directly ask the question, how likely would you be to recommend your advisor? You can see that for the most part, most investors are likely to be promoters or to be those that will recommend their advisor. However, that differs for the mass affluent, who less than half of them are willing to recommend their advisor, but it increases somewhat with wealth. When we ask people, how do you choose an advisor, or how do you decide if your advisor is doing a good job for you, it's all around the concept of trust. They all say, I trust my advisor, or I want to find somebody that I can trust. So we try to ask the question of, how do you prove you can trust someone, or what does one have to do to, show that he or she deserves your trust? So these are the different factors that we find that come up the most frequently. They're proactive in calling me, but that is second to looking out for my best interests. Now, again, that's one of those phrases that who really knows how do you define that, but at the same time, it's the most important. Admitting when they are wrong is important to a third of investors. Charging fees that reflect the value they provide me is most important to the ultra-high net worth, and not making mistakes is another way to show trust. So with that, I'll let George finish up and talk to you a little bit about our newsletters.
You might recall, if you've heard this before, and those of you that are new joining us for the first time, our index that we talked about earlier is always released on the first business day of the month as part of our High Net Worth Insights newsletter. This newsletter is designed for advisors or anyone else who touches a wealthy client on a service level standpoint, product development, marketing professionals, etc. The December 1st issue, has a series of topics, the last 4 stories being our index that we just talked about, but in much more detail in terms of analysis. And then, as always, we pick some hot research topics that we feel would be important, much like we just talked about. Advisor usage will be done probably earlier in the year. But the first article was about when investors don't want you, those that do not use an advisor and why. Earlier this year, we did research with accountants, and this is an article that gives you a little insights about accountants, which are a component of the professionals population, how they use an advisor, when they use them, how to service them, etc. And then a few stories about sort of estate planning and working with wealthy investors in different ways. So this is a tool that we feel is great for any advisor or any individual servicing wealthy clients. Thanks very much for joining us, and we look forward to talking to you early in the year. Have a wonderful holiday and happy 2018.